much. We're looking at these issues of raising capital and what it means for companies. Matt Murphy with us right now from Menlo Ventures. And Matt, you've got this sort of clever way of sort of advising companies and talking to them about some of the 7 deadly sins, maybe the pain of Catholic school coming to be applied to startups. But talking about sort of some of these mistakes that a lot of companies tend to make when they're raising money that seem like good ideas at the time, or seem like the kind of things that might naturally happen, starting with sloth.
Yeah, sure. Well, over the last 3 years, it's been pretty easy to raise capital. And I think the point of the article we wrote, which was the 7 deadly sins of fundraising in this environment, is basically that you need to get your house in order before you raise capital. It's been easy, too easy, and these go in cycles. But certainly some of the things that people did is they were spending too much money, burning too much money, raised it too high of prices, things like that make it complicated in a next round. Specifically with sloth, you had a combination of companies that weren't necessarily market leaders or were in some kind of a product transition.
So a hiccup in growth is a problem.
Yeah, a hiccup in growth. I mean, I think a lot of people over the last few years were willing to bet on the come, that you were going to fix your issues and you would reaccelerate growth, or you would have a next product would fix that. And I think a lot of the industry is kind of absorbing many of its companies right now, and just the bar in terms of what it takes to get funded. So if you have a hiccup in growth, if you are burning too much capital, if you have a product or a founder transition, fix those things before you go to market, because it's a lot harder than it has been over the last 3 years.
And then it's easier, Matt, to have a better or higher valuation. I mean, talk to us a little bit about valuations, and certainly, individuals who are starting up companies, entrepreneurs, are they often kind of way off the mark when it comes to valuations?
Well, I don't necessarily think it's entrepreneurs' fault, but in the early rounds, things have stayed kind of stable. I think it's especially the Series Ds, Cs, Es that got really very high price, even way out ahead of the public markets. So you see some of the later stage companies where they'll price below what their last round is, or new investors looking at the company can't justify paying the price that the last round had. And I think the issue for entrepreneurs is kind of accepting that, being realistic about it, and realizing that they need the capital. So whatever the market price is the market price. You can't get hung up on what your valuation is. You need capital to grow and continue operating the company. And hopefully, now that it's a scarce resource and it's more dilutive, people are going to think a little bit differently about how to run the company with a more efficient burn rate.
And a lower valuation. So we've got the sloth, we've got the pride of too high of a valuation.
Right.
Wrath, this notion of CEO change imminent.
Yeah. Well, again, I think that just kind of goes back to get your house in order, and if you are going to make that change, make it before you go out and raise capital. I think it's a difficult thing to do in the middle of a capital raise, or knowing that a new investor is going to come in and needs to help the existing management.
Which sort of ties into your envy notion of lacking leadership also.
Right. Well, that also is just that I think I don't know if sloppy is the right word, but there were many companies funded in a particular category, and I think now to get funded, you better prove that you have the characteristics to be a leader. I mean, it's best if
not
you
just as an individual leader in a certain space.
Yeah, in your sector. You want to be, best case, you're a category creator, something like a Twilio. But at least if you're going to be in a space where there's other companies, prove that you're on a trajectory to be a leader, and what the attributes are that you're demonstrating that are going to show that you can achieve that.
Hey, Matt, when you go out, I mean, are you finding a lot of good opportunities at this point? What does the environment look like right now?
Yeah, I mean, the environment is pretty healthy. I mean, if you look at enterprise buying patterns, consumer trends, things like that, it's healthy. So it's not like we've had a big, correction in end user consumer enterprise demand. We just got a little bit out over our skis from a valuation spend, kind of grow at all costs mentality. So a lot of companies are kind of adjusting to that and kind of, again, getting their house in order. But if you really look at those companies that are adjusting and getting on top of that quickly and getting to more maybe efficient growth versus expensive grow at all costs, that adjustment's being made, and I think there's a lot of great companies out there that are growing, faster, or maybe I'd say that the number of mature, later stage companies that have real business models is probably at an all-time high in my, 17 years in the venture business.
And it also, I mean, we've 10 seconds left, but we've got so many companies that have already got so much cash, maybe they've got a longer runway till they get out in the public market so they can make the kind of changes they need to get ready.
That's true. I think, there's a lot of companies that raised capital in previous years that don't need to raise capital next year, and that may still be covering up some of the sins. But they better fix the things before they either go public.
There's plenty of sinning going on in Silicon Valley. We got that.
It's getting cleaned up.
Matt Murphy, Managing Director of Menlo Ventures, thank you very much. And we'll toss it back to the Bloomberg TV audience.